Hi, my name's Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And today's episode idea is about what financial planners do differently to their clients. And the idea came about through our regular investment committee discussions in our business, where all the advisors get around the table and sort of talk about and share ideas, which is a really, really important part of our process, I think, because it's important that, the ideas just don't stem from one person and that you critically test what you've been thinking, what approaches may or may not work, where the most attractive parts of the market are. And it's a bit of a sidebar here, but quite often what you find in financial planning practices is they'll have an investment committee, and that investment committee is only a few people. They might have an economist on there, the more senior, maybe the people that own the business. We like to take a different approach in our business. We like to hear from everyone. So, even if an unexperienced or inexperienced person on our team that might have an idea or a different way of looking at things that we haven't thought about, and you just want to make sure that you have a really robust process, it might be an opportunity to educate that individual about why that might not work. But also, I think, as I've said in this podcast a few times, hold strong opinions loosely. It's always good to be open to the fact that there could be a different way to look at things. Anyway, I think innovation in financial services, particularly in Australia, is pretty poor. There's not a lot of innovation that goes on, and not in terms of product. I mean, I think there's some interesting products out there, but innovation in terms of thinking and our approach towards investing. And so what I've observed is that there's some generally accepted wisdom in financial services in Australia, whether it's in the superannuation industry or funds management industry or property industry, where people sort of take, this is the way we do things, and it's almost like verbatim, and there's no one really testing it. And I think it's really highlighted when you get into a discussion and ask advisors, well, what do you do with your money? What's in your super fund? How do you invest? How much do you use borrowings to invest? These sorts of questions. And sometimes what it does is highlight a gap between maybe what the average investor is doing or what advisors are telling clients to do and what they're actually doing themselves. Now, there's a big difference here to call out. Advisors talk to investors every day of the week, and they're, depending on their experience, they might have done that for many years or decades. And so their data set, so they get to witness the consequences of past decisions, they get to experience the consequences of present decisions, and they get to see the good, the bad, and the ugly. And so their data points in terms of that helps their decision making are significant. Whereas an individual investor, particularly if they don't get advice, their data points are very limited. Their own experiences, their friends' experiences, or anyone they sort of talk to about investing, it's a relatively small data set. So, of course, advisors are going to have a different perspective on these things, and that different perspective and beliefs is going to impact their own decisions. But I thought it'd make a great podcast episode just to talk about the 9 things that I think advisors do differently compared to their clients or compared to, your average Australian investor. And it's not a criticism of either the advisor or the client, or the investor, I should say. It's really an observation. And I think what we can do is kind of reflect on these as investors, as listeners to this podcast, and have a think about, do you do some of these things or don't you do some of these things, and what can you learn? Because, building wealth and investing it's a lot about behavioral finance. It's all about our behavior, our response to stimulus, or our discipline to not respond to stimulus, and to really be focused on generating long-term value rather than short-term profit. Anyway, let's get into it today. I've got 9 observations to share with you, but I just wanted to, paint a picture of where this episode came about and what I'm hoping to achieve. Okay, so the first observation is that most financial advisors don't have any bonds in their super fund, which I find a really interesting observation. I think about my own super fund. I don't hold any bonds. I might park some money in bonds for future investing. And I've done that from time to time. But typically, I actually hold quite a bit of cash in my self-managed super fund as well, which is actually probably not an observation I've listed or talked about today. But I think that the reason behind that is I like the optionality. I like if there's great investment, if there's not a compelling investment opportunity, then I'll be happy to leave the money in cash for a little bit. I'm not going to compare myself to Warren Buffett, but I know Berkshire Hathaway has a lot of cash and their approach is kind of the same. Whereas sometimes clients are so eager to invest, just get the money and make it work for you, which is not wrong. There's no, it's horses for courses. But anyway, most advisors don't hold bonds in their super fund, which is interesting because it's really at odds with what the industry is doing. Most industry super funds have, even a high growth fund will have some level of bonds in it, but a lot of people are hardwired to go balanced or growth or high growth, and it will be a pre-mixed asset allocation, which will include some assets that most advisors wouldn't have, like infrastructure, for example. I haven't surveyed the advisors in our business, but I would hesitate to guess that there's probably not much in infrastructure. And the best way to describe it, arguably, is that most advisors would invest their entire superannuation in equities, in share markets, rather than anything else. And I think the reason for that is that advisors are constructing that portfolio to maximize decade-long returns. So they realize very clearly that they don't really care about volatility. They just care about maximizing returns between now and 60 or now and 70. You don't even, in terms of investment time horizon, your investment time horizon's arguably as long as you're going to live. So it could be many, many decades, even if you're in your 40s and 50s. And the idea is that you want to invest in a way that's going to maximize returns. And shares, equities, are almost always and have almost always delivered the best long-term returns, not necessarily on a year-by-year basis, but long-term returns. And so if you want to learn more about this way of thinking, episode 310, we talked about investing your super 100% in shares. And interestingly enough, there are more options now available within industry super funds and other sort of platforms and products like Vanguard Super, for instance, to invest 100% of your balance in the share market. But it's interesting that, advisors will advise clients, this is an asset allocation, let's go balance, let's go growth, whatever it might be. But what they're doing themselves is different. And I think it's about having the guts to test conventional wisdom, and something we're doing a lot more in our business. We've spoken in past episodes about we're not that excited about the Australian market, so we'd rather have a lot in international markets and a little bit more in emerging markets. And we're also not in love with bonds anymore in terms of, depending on the client, of course, but if our goal is to maximize multi-decade long returns, then we know that putting all the money in the share market's more likely to do that. Which is a great segue into the second observation, which is they see volatility as an opportunity, not a danger. And reframing volatility is a really interesting one. It's one that we talk to clients a bit about, and it's one that clients can be concerned about. No one wants to lose their money, but I think we've got to make a distinction between a temporary loss and a permanent loss. A temporary loss is my balance has gone down, but it's all part of the process. Volatility is normal, it's expected, it happens all the time. When I say all the time, every year there's going to be an intra-year period where the market's down 10%. That the statistics tell us that. So we've got to expect it's all normal. And so that's a temporary loss. A permanent loss is something that's fundamentally gone wrong with the investment. And there's always risk with some investments, and some of those risks can be wildly remote. But the reality is those wildly remote things occur. They happen. They do happen from time to time. You've got to be unlucky for it to happen, but they do happen. Most mistakes, though, are a result of making a fundamentally unsound decision, which, is kind of the focus of my new book, Wealth by Design, is building a rules-based system around making those investment decisions to avoid those common mistakes. So when volatility happens, most advisors are excited about the prospect, including myself. Like if the market drops 30%, I'm actually pretty happy. I start to think about, okay, what cash do I have to invest? Should I even borrow to invest? If the market dropped 30%, I'm telling you, I've got some unused loan facilities, which are always good to have. If you're lucky enough in a situation where you've got the borrowing capacity and the equity in property, always have unused loan facilities, because if the market dropped 30%, I'm in, and I'm in a big way. And I know that history tells me that that would be a great decision. Might not be a great decision in 3 months' time or 6 months' time, but it'll certainly be a great decision 5 to 10, 20 years from now, particularly 20 years from now. So we see volatility as a great opportunity, a welcomed opportunity, rather than a danger and something to avoid. The third observation is that advisors use debt borrowing to invest deliberately, not aggressively. Actually, not even just borrowing to invest, also, borrowing to purchase a home loan. Whereas the average Australian investor tends to kind of fall into three cohorts or three camps. There's one camp that will borrow to invest or borrow to buy property, but will be focused as a priority in repaying or reducing that debt. So they hate debt, they're willing to do it, but they want to reduce debt as fast as possible, and they'll be really focused on doing that. That's one cohort. At the other end of the spectrum is a cohort will borrow as much as the bank will lend them without any consideration to whether they should do it. They just sort of take it to the extreme to say more debt is good debt, and the more I can borrow, the more I can invest. The more I invest, the more I'll make money, which theoretically could be true, of course, but it doesn't work at the extremes. The extremes, an extra $1 million of debt can actually mean the difference between being in a prudent, comfortable financial position and taking way too much risk relative to income and asset base. And then there's a cohort that sits in the middle. And the cohort that sits in the middle are advisors and some Australians, of course. But in my experience over the last almost 25 years, I find that people tend to be on either ends of those two spectrums. They hate debt. They've wasted the last 20 years by repaying debt rather than investing in growth assets, or they've got way too much debt and it's crazy. It might work out, but equally it's high risk and it could blow up one day. Whereas most advisors that I speak to, they tend to be conservative, relatively conservative, I guess, to an extent, where they're quite happy to borrow and they're very happy to borrow to invest because they know they're investing in good quality assets, but they're not going to be crazy and borrow 10 times their income, for instance. And also they're not actually that worried about repaying debt, especially if it's investment debt. I mean, it's all relative to their investment strategy, of course, but they realize that holding on to debt in the long run, inflation really eats away at the balance. So, if I borrow $1 million today, it's a lot of money. Well, actually, if I go back, say, 20 years ago, the average would be very uncommon for someone to come to a business and borrow $1 million. That would be an extraordinarily large loan. Today, it's kind of a bit average. And in 20 years' time, $1 million is going to be nothing. It's probably going to be like 250 in today's dollars. So, most advisors realize, yes, I borrow a lot of money today, but in 20 years' time, it's not a lot. And if I invest it well, the compounding capital growth, the value of the asset relative to the debt will be immaterial. So they're not worried about repaying it, and they're worried more about more growth assets, but they're not going to go to the extent where, they're borrowing 10 times income. So it's kind of an interesting balance. It's certainly the balance that we seek to achieve when advising clients. But when we're meeting clients that don't have that sort of advice, we find that's sort of the two other camps that they fall into. The fourth observation is they invest regularly instead of just waiting for certainty. So I guess another way to put it is there's always going to be a reason not to invest, not to do something. And we find clients ask us questions like, well, given the Iraq war, given what Trump's doing with tariffs, or given that interest rates are rising, or given the uncertainty with taxation changes, should we do X, Y, and Z? And look, sometimes the answer is no, let's hold fire for a couple of months and not do anything. I mean, particularly around the tax changes, they're pretty significant. And we've told a lot of clients, look, just hold fire, let's see how this all plays out before we either pivot in terms of strategy or decide to continue with the existing strategy. So sometimes the right thing is do nothing. But with respect to investing, it's almost always not the right decision. And I think advisors are far more disciplined with this. And I think it probably comes back to their data points and their experience. They've seen times where maybe they haven't invested and look back and they go, well, I should have done that. Like in March and April 2020 was really the best time to invest in the last 5 years. How many of us that are listening did that? And, you learn from those mistakes, not only in advising clients, but also in looking after your own money. So I guess advisors have the benefit of that hindsight more so than the average Australian investor, but they have the discipline to stick to it. I mean, the reality is there's always somewhere to invest. There's some part of the market that looks attractive. I haven't in 25 years come across a situation where everything is overcooked, everything is risky, and there's nothing to invest in. I certainly don't believe it can't happen, Maybe it can happen one day and then sitting on cash is the right way to go. But there's always somewhere you can put your money that is an attractive proposition. And we know that success comes from the discipline of sticking to that plan and that regular investing. And, I was reading something the other day that the person was making the observation that if you just invest, actually, it was the interview online, invest 30% of your income every month and do it for 20 years, you'll be gobsmacked at the results. And it's so true that, and I've said this many times, that the advance you make in the first 10 years is almost immeasurable. You're not moving the dial very much other than your capital contributions. But after 20 years of doing it, it's extraordinary. And that's the reality of it. I guess advisors can see that because they see clients that have traveled that road for 30 years and they see where they are. And conversely, they see clients that haven't done that and they see where they are. And that data point really gives them the confidence and discipline to stick to the plan and invest on a regular basis, whether that's super contributions, regular investing in the share market through debt recycling strategies, whatever it might be within their strategy, but every month they're putting some sort of capital towards their financial future. The next observation is that advisors invest first and spend what's left over. So they prioritize investing, which is another way of saying they manage cash flow well. But I don't think that's true, actually. From my conversations, that isn't always true, which means they don't necessarily go back and have a look at what their spending is in different categories, have budgets and, make sure they're on the right track, which I think, is a good sort of cash flow discipline. And I have a episode coming up about that. I'm going to share sort of what I do using AI now, which is a pretty amazing sort of help in managing cash flow and understanding spending habits. Anyway, it's not just about that. It's deeper than that. It's deeper. It's about prioritizing the money they're going to invest first. And if you do that and you spend what's left over, you're never going to go off the rails because you've prioritized the most important thing first, which is investing for your future. So it's a really good habit to have. I mean, I think, as I said, round it out and have good cash flow discipline. But it's really surprising that, Australians don't do that. A lot of investors in Australia don't do that. And a lot of Australians don't actually know how much they're spending. So if you ask on general living expenses every year, what do you spend? Most people will have to go down, sit down and work it out. And look, to my mind, that's just some evidence that it's got poor cash flow management discipline. Said I'm going to talk about this in a few weeks' time, and I've done a few past episodes, but of course, as we should expect, we're going to get better and better at these things. So certainly that's something that I've found with advisors. Now, certainly younger advisors might not need to manage cash flow as aggressively as other people with more discretionary income because, they probably have a big mortgage, they've got expenses, school fees, these sorts of things. So there's probably not a lot of discretionary spending going on anyway after they make investments, but certainly they prioritize investing and, pay yourself first is that sort of methodology of making sure you do the most important thing first, which is, I think, a habit, one of the habits from Stephen Covey's book. So it's always a good habit to follow. The sixth observation is that they know whether their strategy is working. Now, of course, that's their job, right? To build an investment strategy and implement it and make sure it's a successful strategy. So you would hope that, they're doing this just like you would hope that a plumber, doesn't have any leaking pipes in their own home. And of course that's true, but it's kind of more than that. So what financial advisors will do is tend to have an asset and liability statement. And so they'd sort of calculate their net worth, particularly the value of their investment assets, and they would track that on an ongoing basis. And it might be a couple of times a year, it might be more often than that, it might be at least annually, but they're going to want to make sure that they're making some sort of progress. But actually it's deeper than that. What they really want to look at is their strategy working? Now, you might invest in a property and it might not grow for the first 5 years. That's not a failure in the strategy. That's just the unpredictability of the distribution and sequencing of returns. That's okay. We can kind of live with that. So it's not just about seeing that amount rise, although hopefully with diversification and the right approach, you should see it rise consistently in terms of your net investment assets. But that's not the point. It's really about understanding, are you making progress? Should you pivot? Is it growing at the rate that it needs to? Is your strategy working? Are any adjustments required? And probably the best analogy I can share here is it's like a business having a bookkeeper, right? A business has a bookkeeper, they put all the transactions into Xero or file all the transactions in Xero, and they produce a profit and loss statement at the end of every month or quarter. That's the process of accounting, but that's useless if no one's actually looking at it and asking themselves the right questions contributions. So if a business owner thinks that all they need to do is just tick that box, get the bookkeeper to do the bookkeeping, aka the P&L is there, it is what it is, let's move on. That's a misnomer. Your responsibility is actually just to look at the numbers, understand the numbers, and work out whether you need to make any changes as a result of the information that provides you. And it's exactly the same with financial advisors and having a strategy. And so for listeners of this podcast that don't have a financial advisor, you need to be doing that. And for those that do have a financial advisor, you want to make sure that you've got the confidence you're on the right track, that there's nothing that you need to do. And most advisors are doing this anyway, of course, that's their job. But, that it gives you the confidence that not only, okay, my net investment assets have improved by 10, 15%, that's great, but really, am I on track? Is everything working? Do I need to make any changes? Is critical element to that. But you can only manage what you measure. And I guess the key point here, or key observation, number 6, is they certainly measure and measure what is important with that respect. The 7th observation is they treat super as a serious wealth building asset. Now, by that, I mean most financial advisors are making additional super contributions irrespective of age. They might not be maximizing their concessional cap, but they're making some form of additional super contributions. And I find that is true whether they're in their 20s, 30s, or 40s, whereas with the average Australian, super tends to be an afterthought. And hopefully this is changing, but I think it doesn't really require a lot of energy to make sure that you're in the right super fund, that your fees aren't too high, that your returns are good, that you've got good transparency, that you're maximizing the compounding capital growth and reducing the tax and fee drag. That's a relatively easy thing to do. And then the next question then is, am I putting enough money into super? And you should be taking that approach really from day one. So in your early 20s, if you're thinking about super, that's the approach. And if you can take that approach for the rest of your working life, you're going to be in a fantastic situation. Whereas historically, I think most people have been disengaged with super and they haven't really thought about it and they've wasted a lot of opportunity, I think. Well, advisors don't do that. They see the opportunity and they harness it. Again, it's their core competency, so you would expect them to do so. But again, I think calling out, what do I see advisors do irrespective of age versus the average Australian, I think it's good just to highlight these key differences because these are the things that are really going to move the dial. They're not difficult to optimize. They're not difficult to nail down and get advice and information on, especially these days. So they're easily solved with an hour or two a year in terms of focusing on your superannuation, how it's invested and performing and those sorts of things. That investment of 1 or 2 hours a year for the rest of your working life will be really the best investment that you can make. I should say every year, people that have been listening to this podcast for a while will know every year around July, end of July, I prepare a episode that reviews returns for the financial year just past. I'm planning to do that next month, of course. But this year, I'm going to build that report out. So it's going to be a much more detailed, it's not going to be a blog, it's going to be a detailed report. And what I hope to do is produce a tool that we will continue to improve and add to each and every year to help people with this very challenge of making sure their super is invested in a way that's going to maximize their long-term outcomes. The 8th observation is that most advisors, when investing their super, they use a wrap platform or a self-managed super fund. Very few advisors use an industry super fund. I think that's an interesting observation. Now, the first thing I need to call out is that, of course, they can do that without needing to pay for financial advice fees. So I get one of the hurdles of using a self-managed super fund or wrap platform is, you as the listener needs to decide how to invest. You've got to be self-directed in terms of constructing a portfolio, and not everyone's going to have the time or experience or inclination to do that. So I get that that's a massive hurdle to get over to work out whether that's the right thing for you to do. And so I acknowledge that, but let's just put that aside for a second, because what I want to do is sort of focus on it's evidence that demonstrates there's merit to using a more comprehensive, transparent, flexible platform for investing your super, whether it's a wrap or whether it's a self-managed super fund. There's merit to those decisions beyond, what advisors might be advising to generate income. So what I'm trying to say is there's actual merit there, other than there's, maybe an incentive, to sell a more complex product, because if I sell a more complex product, of course, then the client's going to need to continue to pay my fees. I know it sounds a bit skeptical, but I think it's still a good observation. I mean, put the question a different way. Why are most advisors advisors using wrap platforms or self-managed super funds. What am I missing? What's attracting them to doing that? Now, of course, you've got to get over that hurdle. You've got to pay for advice unless you've got the skill and experience to do it yourself. But hopefully there's a lot of things that an advisor can help you with in addition to super. So hopefully it's only part of the fee that's going towards constructing and managing that portfolio. But I know that there's a big uptick, saw something in the media more recently, big uptake in people taking money out of industry super funds and starting their own self-managed super fund. I don't necessarily think that's good or bad, but I think there's a risk here that if people do it and don't invest it well, then they'll probably be worse off. Whereas, so it's not a magical bullet where you can have a wrap or self-managed super fund and you'd be magically better off. Of course, it really depends on what you're going to invest in and what returns you'll achieve over the coming years and decades. But I just wanted to share that observation because I think what it does demonstrate is there is actual merit. If I talk about myself, I've either had a wrap product or a self-managed super fund for more than 25 years. So I certainly fall into this cohort. And the ninth observation and the last observation I'd like to share with you, and perhaps this might be the most surprising observation of the 9 that I've shared, is that advisors don't look at the market every day. So I certainly don't. I couldn't tell you at the end of most days, I couldn't tell you whether the ASX or S&P was up or down. I think in times of much higher volatility, I probably could tell you because I would track it more often. But in your normal average market, we wouldn't look at it. I would look at the balances of my investment accounts, I think probably once a month, maybe sometimes not even that often. And during times of volatility, I probably don't even change that either. Like I don't even bother looking at it. What's the point? Whereas I find some investors will tell me they look at it daily. Now we've got to be really careful about that, and we've got to realize that as investors we are our greatest risk potentially, because what happens with human beings is there's a stimulus and then we feel like we need to react to that stimulus. And so the more stimulation you feed yourself, the more chance there is to react. I know it kind of sounds counterintuitive because I'm not saying ignore it, don't care about it. That's not that at all. It's just if I look at a client's portfolio every day, I've got to resist the temptation to make changes. I know that sounds really weird because we could always invent something that I might want to tinker with, but the reality is that if the investments aren't wrong, if they're fundamentally sound, just stick with it. Reduce that drag of fees and taxes resulting from making changes. So you've got to find the right balance between taking enough interest and proactively managing your money, but not over managing it to the extent where it becomes a disadvantage rather than an advantage. Okay, so they're the 9 observations that I wanted to share today. What does this all mean? Well, I think firstly, it's worth acknowledging there's some broadly accepted conventions in the Australian financial services industry that most professionals sort of comply with that don't necessarily make a lot of sense. That's not intended to be a criticism. I think for the most part, financial advisors are doing their best. And there's a lot of larger firms, for example, that will have a lot of guardrails in place that won't allow advisors to move out of, that sort of generally accepted wisdom. But we're really cautious with this internally. We don't want to be different for the sake of being different, but we always like to challenge conventional wisdom. And the first question we ask is, what do we do with our own money? If it was our own money, what would we be doing? What approach would we be taking? And put differently, if the client was my parents or my sister or my brother or, a family member that I really cared about, what would the advice be? And is it different to what we're telling the client today? And to continue to kind of challenge that conventional wisdom, I think is really important. Again, not because we want the answer to always be different. That's a nonsense. But really just to make sure that we're not repeating mistakes or what now we might see as mistakes just because, well, that's how the industry's always done it, or, we don't want to depart too far away from what the average looks like because we feel that's risky. If at the end of the day we have high conviction and a lot of evidence to demonstrate it is in fact the best approach, and the generally accepted conventional wisdom is not, then of course we should consider that when formulating advice. I think the second part to this is when choosing a financial advisor, you want them to eat their own cooking. So, in other words, do they practice what they preach? There's a sort of crude but correct saying that a poor man can't teach another poor man how to become a rich. Only a rich man can teach a poor man how to become rich. Now, it has some merit in that I think it seems much more authentic and credible if what I'm telling you to do, I do myself, which is exactly correct in Pro Solution. The way we invest, I invest in a regular monthly basis, and I make exactly the same investments that my clients make. And so I think that carries a lot of authenticity. And, if you're taking advice from someone, it doesn't necessarily, I guess theoretically, you can take advice from someone that knows what you should do, but might not be doing it itself. But from my perspective, I think it lacks credibility. So not every financial advisor you meet is going to be independently wealthy, but you hopefully expect they're going to practice what they preach. And before I let you go, just a quick heads up. Every Thursday for the next 8 weeks, I'm going to publish an 8-part series. What I'm going to do is look at the 8 rules from my new book, Wealth by Design, and show how my thinking on each of those 8 rules have changed since I wrote Investopoly 8 years ago. So some of these I've completely rethought. Some I've just tightened. Some I'm even more sure about today. But the first episode is tomorrow. And as I said, for the next 8 weeks, I will publish an episode on each of those 8 rules. And I hope you'll join me then. They'll go for about sort of 15 to 20 minutes. So shorter episodes, pretty punchy, and hopefully you get some value from them. Until then, bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.